We're being joined by Ying Yi Ann Cheng from Coolabah Capital. We're going to talk about what's going on with interest rates. And if you take the indications from the Reserve Bank in its latest minutes, you have to say not very much at all. Ying Yi, great to see you.
Great to see you, Peter. That's right. That's right. Yeah, look, I mean, if anything, the market is clearly sort of ignoring what is a very, cautious RBA, given their rhetoric around, global trend towards withdrawing policy support. So, the RBA's view is that the cash rate is likely to remain on hold until 2024, given an expected slow recovery in wage growth and inflation. Now, the RBA does definitely sound very adamant compared to its global peers, whether it's in New Zealand, England, or even the Fed for that matter, who is likely to raise rates next year. And obviously we've already started seeing, hawkish moves from New Zealand and England already, but the RBA seems to be quite adamant that they probably want to be the last central bank, at least of most of those developed economies, to make a move. Our view is that the RBA will likely hike rates in 2023. For now, from a domestic point of view, there's no sort of signs of inflationary pressure compared to, say, our offshore sort of peers. So, yeah, it gives us some food for thought there.
Yeah. Yes, Ying Yi, I interviewed Bill Evans from Westpac last week. And Bill quite surprised me by saying that he thought that 2022 is going to have a 7% growth, which is big, which is very big. And given the fact that you kind of think the first half of 2022 is going to be slower than 7%, the second half, to me, sounds going to be really, really fast growth, which means that the 2023 call on interest rates by you guys seems far more believable than 2024.
Yeah, that's definitely sort of the case. I mean, look, I think the RBA themselves are quite optimistic about economic recovery, and that's because, we have New South Wales reopening, we have Victoria reopening as well. So there's a lot of pent-up demand that will likely sort of take place, and obviously, that will be very, very good for consumer spending, and consumer spending, and also businesses as well. Not having the issue of knowing, when we get another lockdown, when will we get another lockdown? So I think that will be good from a business sort of borrowing sort of perspective, and broadly for economic activity. However, the RBA is laser focused on wages and inflation, as we've spoken about many a times, and that as an indicator still remains subdued. And our core view is that once borders do reopen as well, that influx of skilled migration that at a federal level that Scott Morrison and Josh Frydenberg are very concentrated on, and also the New South Wales Premier Dominic Perrottet, very focused on bringing in that skilled migration, that will have the effect of putting downward pressure on wages. So that will work, against the view, at least in terms of pushing the RBA towards rate hikes.
Do you think, deep down, the RBA, if it can see house prices slowing down, they'll rise next year, but I presume at a slower rate, that they would like to keep interest rates as low as possible, to even keep the dollar low, because a low dollar is very good for economic growth?
Yeah, definitely. There are definitely key advantages in having a lower Aussie dollar and keeping long end rates low. I mean, that was the whole point of them really trying to use or go down the QE avenue to make our exporters more competitive. However, with respect to sort of housing, look, I think what would actually be good and is likely to eventuate is that the banks will likely do out-of-cycle rate hikes. So that will put some dampening pressure, firstly, on the housing market, which, as we know, has been strong, but that pace of growth in itself has probably slowed down a bit since March this year. However, you know, the banks themselves, and this is more of a technical thing that we've actually been trading at Coolabah as well, is simply that the banks, from what we know, have to issue quite a lot of debt going forward. So typically in the last sort of 10 years before March 2020, they would typically issue around $140 billion worth of debt to maintain their maturity profile as part of their issuance program. We actually think that number is going to be closer to about $170 to $190 billion a year. Now, the banks themselves have been very lucky because they've been able to enjoy very cheap money by borrowing off the RBA via the Term Funding Facility. Yeah. That facility is now over. As we know, the RBA decided not to extend that. And then at the same time, we also have a separate dynamic that has been a theme of the Coolabah portfolios, is that APRA has also recently announced that the CLF, which is a committed liquidity facility, will now be shut down by the end of next year. That committed liquidity facility has, in a nutshell, allowed the banks to hold alternative liquid assets as a form of emergency liquidity, as an alternative to government bonds. Now, inside this facility, the banks have been able to hold their internal loans. They've also been able to hold each other's bonds. So this bank senior bond. Because this facility has been closed, banks themselves will no longer be the largest buyer of each other's bonds anymore. Wow. So the cost of borrowing for the banks, therefore, since there is no sort of, you know, regulatory arbitrage sort of a need to hold this, the banks will need to be forced to pay a higher rate of funding. And that higher rate of funding, guess what, finds itself towards the end borrower at the end of the day. So mortgage rates, you know, we would expect the banks as a result to be doing out of cycle rate hikes because their own cost of funding is going to be reflected.
Okay. So the big story is, just in case people weren't smart enough to understand the highbrow explanation, a brilliant, albeit brilliant explanation, is, and you gave us the clue earlier, out of cycle interest rate rises. So even though you might say, okay, the RBA might not raise until late 2023 or 2024, to the normal borrower, it might not matter because the banks might raise interest rates at the end of 2022 or 2023.
That's right. They could raise, yeah, next year, early next year, for example. And then the other thing to also consider is that APRA has been, you know, looking at the housing market, and they're quite concerned about the serviceability of all of these loans. So in the past, we know that APRA engaged in macroprudential policy to put a halt on the housing market, and they were most concerned last time with, you know, investor loans. This time, it's not so much the investor loans that they're concerned about, it's more broadly speaking, the serviceability of these mortgages. Given that we are at historically very low rates, as those rates move higher, you know, are these serviceable as a result? So we'd expect that sort of macro proof to also, again, have the effect of dampening the housing market. Okay,
well, I think you've given us enough scary food for thought. If you...
Not to be scary.
Yeah, well, yeah, the thing is I think a lot of people have presumed that the banks would only raise interest rates if the Reserve Bank did. But the point you made is, no, they might have to raise before the Reserve Bank.
That's right. That's right.
Very scary, but very interesting. Thanks for joining us, Ying Yi.
Thank you, Peter.